Japan just raised interest rates again, and most people probably saw that headline and thought absolutely nothing of it. But what if I told you this could be connected to why crypto keeps struggling at key levels, why volatility suddenly returns out of nowhere, why AI stocks have become unstable recently, and why institutions are quietly preparing for a completely different financial environment? Because I don't think this is just a Japan story anymore. I think this is a liquidity story. And more importantly, I think we may already be seeing the theory play out in real time. Now, if you've watched this channel for a while, you'll know we've already spoken about why Japan matters. But today, I want to go deeper than that. I want to look at whether what's actually happening in the markets right now fits into the macro theory people have been warning about for years. Because if it does, then crypto may be entering a completely new phase where it behaves less like an isolated speculative market and more like a real time stress indicator for the global financial system. And I think that changes how people need to understand this entire space. So, in today's video, we're going to break down what the carry trade really is, why Japan became one of the hidden engines behind global liquidity, how markets reacted the last time this started unwinding, and why crypto, stablecoins, and tokenized finance may all become more important if this trend continues. And if you're new here, my name's Paula. On this channel, we look at the bigger picture behind crypto, macro, and the future financial system. And quickly before we start, if you want to understand the exact strategies we use for trading in the crypto wolf pack in both the bull market and the bear market, we've made a completely free trading course for you. I'll leave the link in the description of this video. So first, let's simplify this Japan story properly. For decades, Japan has had extremely low rates, basically near zero, which meant global institutions could borrow money in yen incredibly cheaply. Then they'd take that cheap money and move it somewhere else that offered higher returns. US stocks, tech companies, real estate, bonds, emerging markets, and crypto. That is what's called the carry trade. And this became enormous over time. Cheap Japanese liquidity quietly flowed into risk assets all over the world. But the entire strategy only really works properly when borrowing in Japan stays extremely cheap. The second Japanese rates start rising, the maths change. Suddenly, borrowing costs increase, currency risk changes, institutions become more cautious, positions start getting reduced, meaning liquidity can begin flowing out of markets instead of into them. Now, here's the part I think retail still massively underestimates. Modern markets are unbelievably dependent on liquidity, probably far more than people realise. For years, markets have operated in an environment where central banks injected huge amounts of cheap money into the system. And that cheap money boosted stocks and property, venture capital, tech growth, and eventually crypto. But now we're in a much more unstable phase because governments are trapped. Inflation still exists. Debt levels are enormous. Economic growth is slowing in many regions, and central banks are trying to manage all of this at once. And Japan sits right in the middle of that problem because Japan spent decades holding rates down to keep the system functioning. But now inflation pressures have forced the Bank of Japan to slowly normalise policy, and markets are watching extremely carefully because the entire global liquidity environment can be affected by what happens there. Now, here's where I think this video becomes more interesting because instead of just discussing the theory, let's ask a better question. Does current market behaviour actually fit the theory? And honestly, in a lot of ways, yes. Look at what's happened recently. Bitcoin has struggled to maintain momentum, altcoins have underperformed badly, trading volumes have weakened, markets have become hypersensitive to macro headlines again. Even AI stocks, which were almost moving vertically at one stage, have suddenly become far more volatile. And this is important because speculative sectors usually weaken first when liquidity conditions tighten underneath the surface. That's historically what tends to happen. The most on risk assets feel it first. And crypto is one of the purest liquidity assets in the world. When money flows aggressively into markets, crypto often explodes higher. When liquidity tightens, crypto usually feels the stress very quickly. That's why I think crypto is increasingly becoming something much bigger than people originally imagined. It's no longer just an alternative financial experiment. It's becoming almost like a live global liquidity monitor. You can often see fear, stress, and capital repositioning appear in crypto before the wider economy fully reacts. Not perfectly every time, obviously, but increasingly, crypto reacts directly to bond yields, central bank commentary, dollar strength, global liquidity conditions, and institutional risk appetite. I think that's one of the biggest changes this cycle. The old crypto market was mostly narrative driven: halvings, retail hype, meme coins, influencers. Now, macro increasingly dominates the direction of markets. And the more institutional money enters crypto, the more connected crypto becomes to the wider financial system. That's why stories like Japan matter so much now. But let's take this one step further. Because what happens if this carry trade unwind becomes structural rather than temporary? That's where the implications become enormous. Because if the era of ultra cheap liquidity slowly starts fading, the entire financial system may need to adapt. And I think this is exactly why we're suddenly seeing such massive interest in stablecoins, tokenisation, digital settlement rails, AI driven finance, and programmable money. Not necessarily because traditional finance loves crypto, but because the current system is showing signs of strain. Markets are becoming faster and more interconnected than ever before, which means instability can spread faster too. And that creates demand for new infrastructure. That's why I keep saying that the biggest crypto story isn't speculation anymore, it's infrastructure. Because increasingly institutions are exploring crypto technology not as a rebellion against finance, but as an upgrade to finance. And suddenly, stablecoins make sense, tokenized treasuries make sense, instant settlement makes sense, interoperability makes sense, and even XRP style liquidity systems start making more sense in a world where moving capital efficiently becomes more important. That doesn't mean every crypto project succeeds, obviously. Far from it, but the broader direction feels very clear. The financial system is evolving, and I think Japan may become one of the key signals historians eventually look back on when discussing the transition away from the ultra cheap liquidity era. Because underneath the surface, this isn't just about one rate hike. It's about whether the entire global financial model of the last 20 years can continue functioning in the same way. So, when people ask why I spend so much time talking about central banks, liquidity, and macro on a crypto channel, this is why. Because crypto isn't sitting outside the financial system anymore. It's increasingly becoming part of where the system is heading next. And I think the people who understand these shifts early, the movement of liquidity, the role of AI, the pressure on traditional finance, and the rise of digital infrastructure may end up understanding this next decade of markets very differently from everyone else. Now, before I go, me and Milkshake Matty have made a completely free TradeBot Pro course. It's a step-by-step beginner guide showing you how to use signal bots for automated trading. From getting set up to having the signals firing on your exchange within around 30 minutes. We walk you through the whole process in a simple way, even if you're completely new to automation trading. You can find it at cryptowolfpack.co.uk, or you can click the link in the description of this video. And if you found this video useful, make sure you hit like, subscribe, and turn notifications on, because we've got a lot more videos coming on AI, macro, liquidity, XRP, tokenization, and the future financial system. And I genuinely love to know your thoughts on this one. Do you think crypto is still trading like an isolated market? Or are we now watching it become part of the core financial infrastructure of the future? Thank you so much for watching, and I'll see you on the next one.